Okay, we have completed part one. Now we are on to part two, which is how to avoid dangerous companies. So, what have we seen in part one? We have seen a company which has got a consistent track record of increasing sales and profits, high returns on capital employed, and the ability to turn a high proportion of profits into free cash flow. These are the three basic points which we have covered in part one. Now, what does part two cover? Borrowed money, banks and investors. This is known as total borrowings. What are hidden debts and that come with companies renting rather than owning assets, which is your leased assets? What are pension fund deficits? And this can be very significant debt liabilities, which we need to see, otherwise, we get into trouble. So, this is chapter 5, the dangers of debt. The what is basically in this chapter, how is debt harmful and how can we see the debt which is good? Maybe a company with high debt is okay, maybe a company with low debt is okay. So how do you come to that justification? See, I'm not going with the numbers because these are UK companies and the numbers are very different over here. So the problem with debt is the debt holder or the person who the institution who is giving you the debt will get paid first and the shareholders will get paid last. So you, the common shareholder, do not have any priority to the debt equity or the bondholder. They will be serviced first before any interest or anything is left for you. So a company with poor financials is investing in poor projects where the returns are less. The debt holders or the persons who are lending, where we saw that fee crashed to the firm, are the ones who are going to eat you up. Understanding financial gearing. So what is financial gearing is, he is giving example of two companies, company A and B. Company A has no debt, company B has lots of debt, and they have chosen to finance $1 billion of assets. One company B says with $1 billion of assets, 800 million is debt, and 10% is shareholders equity. And the company B, there has been an 80% to pay the interest. See how the numbers are different. This is company A. Normal sales is 1000, 1200, 800. Percentage EBITDA, sales, interest zero. This is the PBT. Taxations, you get profit after tax, and this is the percentage change. This is company A turns 1 billion to 200, 1 billion to 200 billion, EBIT and 160, and so on and so forth. Is the 20% is your profit. This is what he is giving you an example over here. So don't get caught off by similar terms. Operational gearing and financial gearing are different concepts. Operational gearing is a change in profits caused by fixed operations of cost. This is operating leverage, we call it. And financial gearing is the change in profits caused by fixed interest of cost. This is we understand in the DuPont analysis which we had done, and this also shared in your match for life. So you can see that. Taking the same example, again this one, sales up down. See how the difference in sales gets added to your debt. Your profit for the shareholders from 96 crores can vary up to 6480. See, the debt interest cost remains the same, but here my EBIT is 200, here my EBIT is 160 because of dip in the sales. So my PBT drops down drastically. It's a, from 80 120 is a very drastic change. See, debt can give you high ROEs. I'm not talking about ROCs over here. High ROEs because your shareholder equity is very less. But if debt is not working in your favor, it can even take you under very soon. So these are four metrics: debt to free cash flow, debt to net operating cash flow, debt to assets, and debt to interest coverage ratio. Debt to free cash flow, you can find the formula over here. So what is debt to free cash flow? If my debt to free cash flow, lower the better. If this number is consistently over 10, it is bad. If it is consistently maybe say 2 3, it is serviceable in the next 2 3 years. So after doing all the capex, after taking care of my business, I can pay down my debt in 3 years with the free cash flow, right? A measure and some example of Rolls Royce, how it happens, and it takes so many years. It will take about 200 years to pay down this debt. So he's given an example over here, and this is how the ratio fluctuates. These are the number of years. Sorry, this is the number of years and debt which he will need to free cash flow to pay down. Another examples. Now these are in debt to free cash flows, companies, and some examples of the UK businesses. Debt to net operating cash flow is your OCF, cash flow from operations. So how many years your cash flow from operations would take to, without, if you are not even considering for capex, to pay down your debt. Again, these are the examples of these companies, formulas given above. This is a very interesting one. Debt to assets. So how much of your assets are financed by equity and how much of your assets are financed by debt? Like, if more percent of your assets are financed by debt, you are in a bad position. You are capex heavy business. And what happens to a capex heavy business when the cycle is down? Capex and heavy businesses go down very fast. because they need continuous amount of investments, they need continuous amount of debt or dilution to stay afloat. Now this interest coverage ratio is also a very ratio which has got two components. The formula is here, it's also calculated in our sheet. But sometimes what happens when the companies are doing capex, they are allowed to not show their interest in the P&L. That interest is capitalized and the value of the asset increases. Now what is capitalization? I'll show you a note on this. You can read the note on capitalization of interest, and I think we have discussed it earlier also, but I'll still show you. So the value of the asset goes up, but the amount of interest is not expensed or not deducted in the P&L. So this artificially inflates your profits, right? But in the sheet which we have, let's open up a sheet. Let's take any company, say Ramco. No, this is an IT company. Let's take any company. Let's take Aditya Vision. But this company is also not doing any capex. Are they doing any capex? No, they are not doing any capex. Let's take Mayur Unicodus. Hardly any capex. The capex was here in 2019-20. So let's try and see. So 2019 and 20, when they were doing capex, their borrowings were 34 crores. Now on a 34 crore borrowing, your interest is just 2 crores. So if you divide 2 by 34, you get 5%, and nowhere you are getting loans at 5%. So basically this loans is not at 5%. This is some portion of the debt of these 2 crores plus some portion of the debt is not shown over here. Why it is not shown over here? Because it is added to the amount, 39 crores, it is added to the amount in this amount. So this amount of your asset plus this you are making after depreciation gets this. So again you are making this, so it gets this. So some amount in this 39 is actually the unexpensed portion of the interest cost here, which is added here. So this is called capitalization of interest. So our sheet in the Excel will adjust this, and we don't need to worry about all this. So you see the interest cost ratio over here. The interest cost ratio over here interest coverage ratio, interest coverage ratio over here will adjust this. If this ratio drops below 3, you are into trouble, right? So using debt ratios to analyze, then he is analyzing companies and using all these 4 ratios and doing a comparative analysis. Don't go by the numbers, just understand the subject over here. And then he is giving you some data of what is happening. So high ROCs companies can service their debts very easily because they have got lots of money to save. So debt are of 2 types, fixed rate, floating rate. India we don't have fixed rate, it is always a floating rate. As RBI changes the base rates, loan rates goes up, and as they reduce, the banks reduce, your rates go down. In UK it is Bank of England or LIBOR rate plus minus what the spread is. In here India we have the RBI or plus minus what the spread is. So when does the debt have to be paid back? So he says during the financial crisis there was a lot of fear of companies would have been able to gain access to how new loans were existing. Situations like this have big negative implications for companies with lots of short-term debts because they have to pay back the loans when they were asked. So these are examples how you have to restate and how you have to pay back the debt. Don't again go by the numbers, nothing here in the numbers. Good companies will manage repayment of schedule of the borrowings known as maturity risk. So they don't have to repay and replace large chunks of debt at the same time. So when large debts are not a problem, very good thing over here. When large debts are not a problem, when you have got very high ratios of debt to free cash flow, debt to operating cash flow, then you can use your cash flow and operating cash flow, and you can also track matrices like ROC and CROIC, which we have discussed earlier also, to know how can you pay back your debt easily or no. See again, in Indian context, anywhere between 8% to 13% is good. Beyond 13% is extremely good number. So having now looked at the dangers of debt, in chapter 6 we go and look at how the debt can, you think the company is performing better, but it can really fool you. So very interesting chapter coming up next.